Welcome back to Plan Future AI Insight. I am your Investment DADA, and today we are addressing a vital portfolio structuring question for anyone transitioning from wealth accumulation to the income generation phase. Which strategy is superior for financial planning, dividend distribution, or a systematic withdrawal plan? What an exceptionally pragmatic question. Most investors focus entirely on how to grow their money, completely overlooking the critical phase of how to extract it tax efficiently and predictably. By analyzing the mechanics of cash flow design, you are safeguarding your financial longevity. Let's break down the economics, the mathematics, and the tax implications of these two approaches simply and directly. The cost structural difference. To build a flawless retirement or cash flow pipeline, you must understand who controls the tap. With the dividend distribution option, the timing and the amount of your cash flow are entirely at the discretion of the asset management company. If the market faces a downturn and the fund makes no distributable profits, your income completely stops. Furthermore, dividends are taxed directly at your personal income tax slab rates, making them highly inefficient for individuals in the upper tax brackets. Conversely, a systematic withdrawal plan, or SWP, puts complete control back into your hands. You determine the exact amount and the precise date of your monthly income. Structurally, an SWP is treated as a series of partial redemptions. This means you are only taxed on the capital gains component of the withdrawal, not the principal amount. For equity-oriented funds, your long-term capital gains enjoy a significant annual exemption of up to 1.25 lakh rupees, with any excess taxed at a flat rate of just 12.5%. Light bulb the real-world mathematical reality. Let us look at a practical scenario. Suppose you have an accumulated corpus of 50 lakh rupees in an equity mutual fund and require a steady monthly cash flow of 30,000 rupees to manage your lifestyle. If you opt for the dividend option, your cash flow becomes entirely erratic. In a strong market year, the fund might distribute a healthy amount. But during a market correction, the fund manager may choose to skip distributions entirely to preserve capital. You simply cannot structure a dependable household budget around unexpected corporate distributions. If you choose the SWP route, your 30,000 rupees arrives in your bank account like clockwork every month, regardless of short-term market noise. Because only a small fraction of each monthly withdrawal represents actual capital gains, your tax liability is vastly reduced. In fact, during the initial years of an SWP, the actual capital gains component often stays well below the 1.25 lakh rupees exemption threshold, meaning your effective tax outgo can drop to absolutely zero. Trophy DADA's behavioral and mathematical verdict. Without question, the systematic withdrawal plan wins on every single operational and financial metric. Unmatched tax efficiency. By taxing only the gains and utilizing annual exemptions, an SWP preserves far more of your capital under the hood. Complete cash flow predictability. It transforms a volatile equity asset into a dependable monthly paycheck. Preservation of compounding. The bulk of your remaining corpus stays fully invested in the growth option, compounding cleanly without being subjected to continuous tax leakages. The only scenario where dividend path makes sense is if an investor wants absolute operational passivity and has zero dependence on the consistency or size of the cash flow. Rocket DADA's 3-step action plan. Step 1. The structural shift. Audit your existing portfolio. If you hold investments under the dividend option that you rely on for income, work with your distributor to transition them into the growth option. Step 2. The safe withdrawal rule. Set up your monthly SWP at a conservative annual rate of 4 to 5% of your total corpus. These conservative boundaries ensure your principal remains insulated against market volatility. Step 3. The regular plan anchor. Establish this structure via a regular plan with your trusted mutual fund distributor. Managing an SWP requires active behavioral guardrails. During market corrections, an experienced professional will monitor your withdrawal rate, ensuring your portfolio does not suffer from reverse compounding. Glowing star Dada wisdom of the day. True wealth is not merely about accumulating a massive, static number on a screen. It is about establishing a predictable, uninterrupted, and tax-efficient cash flow that serves your life year after year. An SWP constructs a beautifully managed pipeline. A dividend option leaves you dependent on an irregular leak. I'm incredibly proud of you for optimizing the distribution phase of your financial journey today. This level of foresight is exactly how structural prosperity is secured. Please remember, mutual fund investments are subject to market risks, and historical parameters do not guarantee future outcomes. Always consult a qualified professional before modifying your financial structure. Thanks and regards, Kaustav Bishwas from Plan Future. Please visit our website at www.planfuture.in or message us directly on WhatsApp to connect with us for your personalized, data-driven financial planning and structured income solutions. Stay wise, stay disciplined, and protect your financial flow with total conviction. Folded Hands Vision: to empower 1,000 individuals and families to achieve their long-term financial milestones through structured financial planning and strategic product distribution by 2035. Mission: to deliver transparent, data-driven, and technologically advanced financial solutions, rooted in deep empathy and client-centric care.